In a couple of days, depending on when this video gets released, HMRC are making some key changes that are going to affect most business owners across the UK. Most of them have no idea that this is happening, and some of them who do are going to miss the opportunity to act on this if they don't act fast. I'm Mustafa, I'm an accountant, and in the next 10 odd minutes, I'm going to show you exactly what these changes are and what they mean to you as a business owner. And I'll also be showing you the moves that you can play right now before this window closes. Now here's the situation. If you're a limited company director and you're taking dividends, vast majority of you who are watching this probably are, your tax bill is about to go up. And it's not because your profits went up, it's not because you've made a mistake, it's simply because the government have changed the tax rates. Now I'm not here to panic you, the point of this video isn't to generate panic. Some of you who are watching can still do something about this. And if you've got the right structure in place, you can probably absorb it better than the others. But you really need to understand what's changing and understand how it affects your business and your take home. And I don't just mean this in theoretical terms, I mean that you need to know what's happening in actual pounds leaving your bank account. So let's get into it. Let's start with the facts, because most of you have probably read up online that these dividend rates are changing, but you don't actually know what it means for a real business owner. From the 6th of April 2026, dividend tax rates are going to rise across the board. Now the basic rate band is going up to 10.75% from 8.75%. The higher rate band is going up to 35.75% from 33.75%, and the additional rate is unchanged at 39.35%. So it's a 2 percentage point difference. For most of you that might seem a tiny difference, but let me show you what that actually means in practice. Now if you're a director taking 40k dividends per year, which is not unusual for a small business generating decent amounts of profits, that 2 percentage point increase could cost you around about £800 a year. And let's say you carried on taking this level of dividends for the next 10 years, that's about £8,000 in additional tax costs. And if you're taking out dividends and you're touching the higher rate of tax, add more on top of that too. Now before I go in further, let me address the dividend allowance. So you get £500 worth of tax-free dividends every single year. Not a lot really, is it? And it sounds really helpful, but if you look back say 10 years ago, that dividend allowance was almost £5,000 versus today's £500. So if you're a director taking 30k worth of dividends, the tax-free slice is £500. So you're going to pay tax on £29,500 worth of dividends. The allowance in itself has been so heavily cut that most people don't even consider this in their planning. So let me run the numbers for 3 different scenarios because the impact isn't the same for everyone. So scenario A, let's say your profit is £60,000 and you pay yourself a salary of £12,570. The remaining profit after corporation tax leaves you with about £38,000 to declare as dividends, and that will sit entirely within the basic rate tax band. Now under the current rate of 8.75%, your dividend tax is going to be £3,281, and from April 2026 it's going to be 10.75%. So that becomes £4,031. That's an extra cost of £750 per year. Now scenario B, let's say your profits are £100,000. Now here you have a lot more flexibility and a lot more exposure too. Now after salary, corporation tax, and assuming you draw everything a lot more aggressively, portion of your dividends is going to cross into the higher rate threshold. Now let's say £25,000 worth of your dividends fell in the basic rate and £12,000 went up into the higher rate. Now the basic rate portion is going to cost you an extra £500 odd. And the higher rate portion, that's going to cost you an extra £240. So the total extra cost per year for extracting the same dividends is going to be £740 a year. And scenario C, let's say your profits are £150,000 plus. The dividend rate is one of several things you should actually be reviewing. Now you've got pension contributions, you've got your salary structure and retained profits. These all play a key role into your review. Now the raw dividend tax increase could be anywhere from £1,000 to £5,000 plus for you. And that all depends on how you're structured. So I'm going to talk about more on retained profits a little bit later on in the video. These are predictable and quantifiable costs, and some of them can actually be managed. Now by the time most people watch this, we've probably crossed into the 26-27 tax year. So let me be honest, some options have closed, but there's still some things that you can still do. Now action 1, you can accelerate your dividends before April. So if your company has sufficient profits retained and you haven't maxed out your basic rate band in prior years, you may still be able to declare some dividend before the 6th of April 2026 at the lower rates. Now the key word here is declare. A dividend is taxable when you declare it, not necessarily when you actually receive that lump sum of cash. So if your company has the distributable reserves available, your accountant can help you declare a dividend today, right now, and it'll fall under the 25-26 rates. Now do not just take dividends before speaking to your accountant. The paperwork really does matter, but if the window is still open for you and you haven't maxed out, this is genuinely still something worth exploring for you. And action 2 is pension contributions. This is one of the most overlooked reliefs that most business owners just completely miss. This in itself doesn't have a 5th of April deadline. It can be used throughout the whole entire year. Your company can make pension contributions directly into your pension pot and directly also reduce its corporation tax liability. So at 19% corporation tax for profits under 50k, every £1,000 you put into your pension is actually costing you £810. And at 25% corporation tax, that's costing you only £750. And more importantly, those pension contributions that you make directly reduce the amounts that you can distribute for dividends. So rather than taking a 20k dividend and paying say 10.75% in dividend tax, you put that 20k into your pension, the company gets the tax relief right now, and you're building wealth for longer term. Now yes, there is a trade-off here. The trade-off is access. You can't actually access that pot of funds up until you retire. But if you're building longer term wealth and you're thinking long term, this is a powerful tool to use right now. Now here's a strategy that most accountants won't just suggest to you, because it requires a talk about your goals, not just your tax return. Not every single pound of your profit that you make needs to come out as dividends. If you don't need that cash right now, you can leave it sitting in your company and you'll pay corporation tax at anywhere from 19 to 25%. Rather than what you're currently probably doing is paying corporation tax plus then dividends tax when you're extracting that cash as well. That retained profit can then be reinvested in the business. It can be used for any future pension contributions that you want, or extracted further down the line in a more tax efficient manner. And potentially if you're thinking about exiting the company, you could be paying slightly less tax if you're using the business asset disposal relief. But yeah, it's just something to think about, that not every single pound of profit needs to be extracted right now. So let me zoom out for a second, because I don't want this video purely being on a simple tax change. The April 2026 dividend tax rise is just a prompt. It's a prompt to just look at your whole extraction strategy and think, am I doing this as optimally as I could? Most directors that I speak to, they've had a structure set from day one of their business. If that was 10 years ago, they started keeping the salary at £12,570. They've been taking dividends, no pension contributions. They've not even looked at their retained profit strategy. They've just kept it as that. And at that time, it might have been fine. But that may not necessarily be optimal now, especially if your profits have grown. The framework is pretty simple. You've got to think about your goals first, your structure second, and finally, third, you've got to look at your tactics. You've got to think about what you're actually trying to achieve. Are you trying to build wealth? Are you wanting to fund your retirement? Do you want to sell the business in 5 years? Do you want to buy property through the business? Because each goal has a different tax implication. And if you've never had that strategic conversation with your accountant, it's probably something worth noticing. So here's where you are right now. Option 1. You carry on as you are. You absorb the extra dividend tax costs in April and deal with it as a cost of doing business. And for some of you, that's completely fine. Or option 2. You take 30 minutes to review your whole extraction strategy. You maybe might think about accelerating a dividend before April the 6th. You might also want to look at pension contributions and make sure that your current structure, your current strategy is working as efficiently as possible for you. Now I do offer a free discovery call. The link is in my description. Book it, bring your numbers, bring some questions that you have, and let's have an honest conversation about what's open on the table for you. Now if this video has been useful, please subscribe. I put out content like this every other week for UK business owners. And if you know a director, if you know a friend who hasn't heard about these tax changes, make sure you send this video to them. I'm Mustafa and I'll see you in the next one.